The Hedgeless Horseman here. It's January the 16th, 2024. First of all, thanks to the sponsors. Let's look what the marks are doing. Appear to be a bad mood today. Market's down. People are selling metals, bonds, crypto. Anyway, let's dig in. First of all, I thought I would talk about a few things that I think are very important, especially if you want to be able to buy cheap, which is the main goal, but that for some reason almost nobody can actually pull off. Well, it's actually not the buying low, I would say, that is the hard part, is that most people, not even most people, but some people, they might be able to buy low, but they are not able to hold low. Because, I mean, most of the time people don't really know why they should win. So it's like, okay, you hear someone say, well, these miners are really cheap. It's like, you're going to make whatever return from these levels. So then they get enthusiastic. It's like, whoa. Oh, I can, make a lot of money. So they buy, not really knowing the cases typically, or how long it can take for a bear to go into a bull. So if they're not in, well in the money within, let's say, at least a few months, I think a lot of people simply give up. I mean, I've seen that, I saw that in uranium. There's been a lot of chatter for many, many months about the increasingly good fundamentals in uranium. But I know quite a few people who were bullish on uranium, but they sold out in this last bear market. And now uranium has hit over $100 per pound level, I think. And uranium stocks have done well. Obviously, the ones who are now best off are the ones that just kept on at it, kept buying, kept holding into the bear. They believed that, okay, this is a cyclical sector, it's gonna get better one day, and the more it sucks in the now, the higher the delta is going to be from the point of peak suckage to the next, bull top, or at least, leg up. So it's the few that actually increase their buying the lower the bear market goes that are going to end up making the most in the next bull market. But there's no shortage. I mean, look at the uranium juniors now. I mean, they're going up, and a lot of people are jumping in now. But the select few who actually knew it was going to be a bull one day and held on, they are the one that's actually making a lot of bank. Anybody can buy a hot sector and have some names go up, who knows, 50%, maybe even 100%. Problem is that if you're buying high, you're kind of, chasing a rally. You're certainly not the first one in. When do you know when the top is in? I mean, what's your strategy? What if the top is in? What are you going to do then? It's like, if you have no idea what you hold, why you should win, you don't even know the valuation, whatever. I mean, if you buy in close to a bull peak, even if you get 50% pop, you don't know what's going to happen later. I mean, for example, lithium was really, really, really sucky. Then it got really, really, really hot. And some companies went up thousands of percent. Of course, now, after that leg was over, lithium has absolutely sucked. Lithium prices, I think, are down 70-80% from the top. Some juniors are down a lot, obviously, from the top, and you see mines being shut down. So it's like these are just more examples of how, in one way, easy the commodity sector is, because it's always cyclical. There's 100% guarantee there's going to be a bull after a bear, and 100% guarantee there's going to be a bear after a bull. I prefer to be in the bears where the bull is still out there. I mean, it's not come around yet, so I know, okay, the big move is going to be higher. It's going to be one day when it comes, and it might be months or years, but when it comes, I'm going to make a lot of money from these very, very depressed levels. So it's like lithium, it's kind of looking interesting. I don't know too much about lithium, that's the problem. It's like if there's one edge or edges I would like to, increase or gain, that would be, be well versed in more commodities. Because that's certainly an edge. I mean, there's always something that's going to be in a bear market, or typically at least, where there are bargains. But I'm not comfortable buying stuff. If I think oil juniors are cheap, I'm simply not comfortable buying stocks, being an investor in companies that I don't really understand, or have an idea what the value is. And some of those I won't be buying because I don't understand them or have them within my circle of confidence. They might go up a lot. I mean, uranium, it looked like a good case. I mean, the only uranium miner really I've owned is District Metals, because it was a relatively simple bet, like good management team. I met Garrett. They staked the largest or second largest uranium deposit in the world, in Sweden, where there's a moratorium on uranium, meaning you can't mine for uranium. But the idea was that, hey, District Metals is already cheap based on the base metal projects they have in Sweden. And they obviously have super beta to uranium via the Beacon deposit, which is the huge one, and they added a bunch of projects as well. So that was a relatively simple bet. It's like more a bet on management. I understood it. I know, okay, it's more about, it's a beta play with an alpha trigger, legislative trigger. If they lift the moratorium, they have one of the largest uranium deposits in the world. I mean, from, I don't know what the market cap was at that point in time, like, what could it be? Let's say, I don't know, 14 million Canadian. I mean, that's cheap based on the base metal projects, which, I mean, got even more cemented when Boliden did a deal with them on Tontebo. So, I mean, that I understood. I understood the case. It was cheap. That I know. I mean, that's cheap. But I have a hard problem buying a company just because it's the sector is in a bear market, and it's probably cheap. But if I can't see why it's cheap, if you know what I mean, I don't get comfortable with it, and then I won't be able to hold it. Because as soon as it goes down, that's the same with trading sardines in the precious metal space for me. As soon as they go down, I feel stupid. Because I know what I'm doing, which is, it's the greater fool theory. It's like, you might not even, maybe it's not even a good project, and you don't think like I mean, yeah, it looks cheap on face value, or at face value, it's going to go up a lot in a bull market, that. But it just feels weird putting my money into projects where it's like, at face value, it's cheap, but if you think, well, that's not even a good project, or that will never be built, I mean, then you're actually, I mean, yes, that is a trading sardine, kind of. That the value is always theoretically there. It's like Bitcoin. It's always theoretically there, with these, let's say, a huge low-grade deposit. It's probably never going to get built, but it's going to go up, I don't know, tenfold from a bear market bottom to a high. It's just that I can't hold on to them. I don't have the patience. I get pissed off at myself as soon as I see them go down, and especially if they dilute, because in that case, I just feel stupid. But that's me. Some people are able to do that. I actually did that in the early 2015-16. I held a lot of pretty crap companies, some trading sardines like Bear Creek Mining, but the thing was I didn't know much. I mean, I just felt, okay, everything is cheap. It's like Eric Sprott and the likes, telling me silver is cheap, yada yada. So I just bought the biggest amount of silver I could and some producers, and that ended up very well. But again, there was no real opportunity cost because I didn't know much about. I didn't know what a good exploration story was. So that in that case, ignorance was kind of bliss, and I had pretty good timing at the end. Even though my first 4 months was my portfolio was down 54 months. So I mean, in the beginning, it actually looked like some of the worst timing you could possibly have to cut your portfolio in half in the first 4 months. But in my book, it was just I think they were cheap already, but they just got cheaper, so I bought. Anyway, so some other, topics like, okay, if we know gold is at around 2000. We know gold juniors are like historically undervalued. Like you see this stuff every 8 years or so, or maybe every 20 years or so. I mean, they are that cheap. And it's like, it's not that they're only cheap on an absolute basis, but like relative to gold. They are trading like the gold business is kind of worthless. It's never going to be worth anything, at least not in the next 5 years or anything like that. So it's the most no-brainer bet I have ever seen. Again, it's like I bought gold juniors cheap down here, but gold was at $1,000, and no gold mine on earth almost made any money whatsoever. And it was a shitty sector at face value. It was worthless. Almost every project at face value at those prices at that time wouldn't make any money. So that was, speculative in the sense that, hey, right now what I'm buying is not even worth anything really. But people will think it's worth something in the future. And since nothing in commodity space, nothing goes down forever. When it starts to go up, all of a sudden those products will be worth something. That's what we're after really. It's like, just look at how Ross Beatty made his fortune. He bought up a bunch of copper projects I think it was around 2000 or something, when copper was almost given away. Then copper went higher, he made an absolute fortune. So he bought something that at the time was kind of worthless at those prices. But his only win condition kinda is that, well, if we're ever gonna have a bull in copper again, which we is a pretty sure bet, those economics will look totally different. All of a sudden those deposits will be worth something. So if I buy something for almost nothing, and I just wait until the inevitable day comes that they are worth something or a lot, I'm gonna make a shit ton of money, which he did. It's like the Landins do the same thing. They typically buy stuff at fire sale, like Fruta del Norte bought it from Kinross. That was for geopolitical reasons. But they bought it because they got it for a cheap price, were able to put it into production, and then Lundin Gold hit like, 4 billion market cap or something. It's not only that they do that kind of investing. They do a lot of exploration, obviously, like file mining, doing fireweed metals and stuff like that. But it's like the whole idea, either it's, for some reason, it's going to get more expensive in the future. Either it's something de-risked, that is pricing in that there's going to be an eternal bear market, which is a dumb thing to do by the market. But the market always does that. Here, it was priced, the junior sector was priced like it would be a permanent bear market. The ones who called bullshit on that made a lot of money. Here, it was priced like there would be a never-ending bull market. And you couldn't pay, there was no price that was too high if gold was just going to, keep going up. but this sector is cyclical. So if you bet on the fact that, hey, I'm paying a high price, and that goes for major mining companies as well. You buy stuff that's not even cheap because you think this bull is going to continue forever. I mean, we want the next. If the sentiment is frothy, the next big change is for the sentiment to go from frothy to depressed. Yes, it can get more frothy for a period of time, but the gravity is going to take it down. And when it's super depressed, the mean reversion is going to be to the upside. Pretty simple stuff. With that said, given that, in my opinion, this sector is absolutely batshit crazy. The valuations out there don't make any sense at all. They're not pricing in reality. That's what they're not pricing in. So it's batshit crazy. Okay, we know this. But waiting for reality to sink obviously can take time. I mean, nobody, I think, would have guessed, if they looked at the gold price here, how do you think you would have guessed the sentiment would be in the gold junior sector? I would think that gold juniors would be at all-time highs. This is a great looking chart. All-time highs. I would think it would be party time. But it's like one thing, again, it's like, look at this trend here. That's a bit more impressive than, zigzagging for a while to all-time highs. Here you kind of really had that ramp. And nothing, let's say investors, there's nothing they like more than a clear trend. When they're here, they are 100% sure gold is the place to be, because just look at what has happened. And now, for different reasons, inflation, high rates, it's crypto and whatever. It's like the gold junior sector is absolutely depressed, which is that's the whole opportunity. If we complain about dislocations between price and value, if we see that as a negative by default, then we don't even know what we're doing. If we complain about cheap prices, shitty sentiment, etc., what we're doing is we're complaining that we have the opportunity to make outsized future returns. Because if this sector was fairly valued at all times, there would be no opportunities in it. Your future returns would be subpar. But, okay, how do you keep conviction? I think you should be able to sum up your cases in just a few sentences. I can write long articles about juniors, but the no-brainers, you should be able to sum them up really quickly. That's why typically I have early in the article, case in short, basically. You shouldn't need 2 pages to explain a case. You can explain the details, whatever, but if you're gonna do an elevator pitch, it should be obvious. I think it's well enough, like, good management team could be huge, selling for price equivalent of there being no chance it's huge. That's a good bet in my book. It's like, when add skin in the game, whatever. It's like, that's enough. I think some of those cases are really, really good. Just think, again, asymmetrical risk reward. If it's pricing in 5% chance of blue sky or 5% of blue sky, and you think it's 15, and it's 200% undervalued, doesn't mean it's a slam dunk. From a accuracy perspective, it might be an 85% chance of failure, but it's still dirt cheap. So if you diversify that risk away, you own 20 of those companies or whatever, you're gonna the idea is that you will get the mean 200%. One thing I really like to do as well, just to, when I'm, let's say, I mean, there's a lot of crazy valuations out there, but I like to extrapolate valuations and especially do it on a relative basis, for example. Just to show, it's like something might be cheap, but something else might be real cheap. Because in my mind, I'm thinking like, okay, let's say you have these two juniors to choose from, and you're not sure, and one is selling for a lot higher than the other. I mean, the fundamentals probably be very different. At least the sentiment levels in those stocks will be certainly different. Let's say one junior is selling for 4 times the other one, and then you can just like, what I like to do is, okay, imagine if, would I rather own this junior here at 4x or 4 juniors at 1/4 x? Because there was, you probably saw or some might have seen what's the ticker? CNC, Canadian Nickel Company. They did a deal with, Agnico Eagle got in as a shareholder recently after Anglo Gold was already in. I think it was Anglo Gold. No, Anglo American. And then they got a deal done with Samsung recently, or a subsidiary of Samsung. And one of the clauses was that Samsung could buy 10% interest in the project for 100.5 million USD, which is like 135 million Canadian, for 10% of the Crawford project. It's like Magna Mining, for example. The enterprise value is, I think, around, that's basic though, but around 65 million. So around half that for what Samsung could buy 10% of Crawford for. Meaning that, like, would you rather own 2 Magna Minings, meaning 2 Shakespeare mines, 2 Green Hill mines, for 10% or 10% of the Crawford project? I would rather own 4 mines than 10% of that project. I'm not saying Canada nickel isn't cheap. I think many nickel units are cheap, but it's like, when you see how much you can fit in one company into another, I think it really kind of highlights sometimes how weird the market can be. How weird the retail-driven market is when it sets prices. That there's no chance. I mean, if people think there's no opportunities, or that every opportunity is the same, no, I don't think so. I mean, I think there's, a lot of gold units are cheap, but I think some might be hundreds of % cheaper than others, or at least the bet is hundreds of % better. I think I could do a shotgun approach in the gold junior sector right now, pretty much, if I bought 50 random gold juniors. I think the risk is to the upside, but you would have better risk reward if you pick 20, you stock pick 20 juniors that you thought were really cheap, because again, it's like almost any decent to good gold junior right now I think looks like a buy. That's my problem. I have not enough money to buy. Any additional dry powder gets immediately invested. So I'm always fully invested, because there's so many no-brainers. It's like, drives me crazy. It's like I see bias all over the place. And I would like to, I mean, every holding I would like to have more of. And there's juniors I can't, buy even, because there's no money, or it's like I don't want to have a 0.001% stake. I mean, it's not just worth my time. I'd rather stay up to date with the with fewer, then hold every single thing that looks very cheap, and then be forced to be kind of up to date with like 30 juniors or 40 or 50 or something like that. No, that's not the best solution either, I think. But I like that thing. It's the same with well, take something like Inflection Resources, for example. It's like 16 million or 17 million Canadian, I think. How many targets do they have? I don't know. A lot. Like individual targets might be 50 plus or something, but it's like they have a huge land package. A lot of targets, and like 16, 17 million funded by Anglo Gold. It's like, okay, 16, 17 million, and then you look at some. Well, in my example, or take Philo Mining for example, maybe that's 3 billion, and they have a world class deposit there. But like, would I rather own one Philo Mining or 3,000 divided by like 17 Inflection Resources? I would rather buy Inflection Resources. Because if I could own, I don't know, 50 identical Inflection Resources, I think that the ending value will be more than owning one Philo Mining. Because that would be equivalent of, I don't know how, hundreds of targets funded to PFS in Australia. But I like to do stuff like that. I think it's a good exercise because it kind of flushes out some ideas. Because if you have a few that you like, and when you really think about it, it's like, I have an equal amount in this stock that might be hot or whatever, and then you look at some not so hot stock, and when you think about it, it's like, if I had the money, would I rather own four of these juniors, four of this junior, or one of that junior that's priced higher? I mean, typically you will go for the cheaper one because it just sounds weird. Again, like the Canada Nickel Magna thing. It's like, do I think Canada Nickel is expensive? I mean, it's probably not. Not if you look at the, if Samsung's clause is suggesting that, hey, this deposit, 100% of it might be worth 1.35 billion, and the market cap is 300 million. Obviously, there's upside in that case to the inferred valuation put by that Samsung clause. But at the same time, if that's if that's cheap, what does that make Magna in that case? If for I hope you get my point. It's like you can have 4 mines for 10% of Crawford. It's like, I'd rather own 400% of mines than 10% of Crawford. That's my. It's like you have almost would have a small empire with 4 mines in Sudbury. I think it's a good exercise because it really, again, at the bear market bottoms, it might not look like much, let's say one stock is down already 70%, it goes down 20% more, and it's like, well, what does that matter? It goes from down 70% to down 75% from the top or whatever, and you're like, it kind of looks the same, but in reality, that 20% haircut, all of a sudden you might be able to buy 5 of this junior instead of one of some other junior. It really goes, again, the risk reward goes exponential when we're at depressed sentiment levels, and again, it might not look like a lot when it wiggles down at low prices already, but it's like, again, who knows? Maybe if this was a junior here, maybe going from this price here to that price, maybe the risk reward went up 100%. Maybe it got 100% better risk reward just from that little dip here. It certainly goes exponential. That's one thing to, I think, keep in mind, because it's at the end of the day, and I talked about this a lot. It's like, it's not the bear markets that kill people; it's the decisions people make. And that goes for individual stocks as well. I saw someone posted up There was Hercules Silver. They posted a picture where they were talking to, I think, the governor of Idaho or something, and there was someone commented, it's like directed to the CEO, Chris, I think his name is, where they said something like, you burned a lot of retail shareholders, meaning, because it went down 48%. That is just get pissed off seeing that. That is a person who takes no responsibility. Just because the stock goes down, obviously we had high expectations going in, so they didn't drill barn burners in 3 holes. Stock reacted violently, and that's mostly thanks to people like the person who made the comment, and then he gets pissed off and insults the CEO. Like it was his fault, or that he did something stupid for not drilling barn burners. Well, it's not even that. It's that this guy didn't get immediate gratification. Probably bought the high, where it's harder, obviously, to surprise to the upside because expectations are up. So he thought he was going to get rich at the next news release, and everybody else thought so as well, obviously. Goes down, people panic, and it's like, oh, the case is over, and I talked a lot about that. It's like, I find it very hard to kill that big of a target with 3 drill holes, and basically the interview done yesterday by Chris kind of confirms that. It's like, in their mind, they're just starting. So again, it's like, whose fault is it? Or is it anyone's fault? Or is it just how the markets work? And it's like, if you want to get somewhere in investing, I have never sent a scorning email to any management team. I take full responsibility. Sure, there have been, like, let's say, subpar management teams that kind of pissed all the money away, and I lost money and all that. But I just chalk it up to, okay, this happened, there's nothing to do about it now. Can I avoid this in the future? Because if I take no responsibility, that means I'm not going to try to fix anything, because in my mind there's nothing to fix. No, I couldn't possibly have foreseen this. It was just, management team fooled me. It's like, everything is out of my control. A lot of stuff is out of our control, but I think the basis should be that's like, I take full control, full responsibility about everything. I think it's just weak to whine. Because it doesn't help you. That's the thing. It's like you're shooting yourself in the foot if you put the responsibility on someone else. Even if it wasn't your fault, if you know what I mean. It's like, I don't fault management teams for drilling and missing or whatever. I remember, I think Ross Beatty and like Rick Rule said that as well. It's like they get pissed off when they give money to companies and they don't say what they were promised they were going to do with the money. They don't get pissed off because a junior they give money doesn't make a world-class discovery or whatever, because the odds are always against you. And common sense, if you, let's say you put in money at a 20 million market cap, you hope that they will find a tier 2, tier 1 mine. You can just imagine the payoff and how low accuracy that is implied. It's like, if there's even a 10% chance that's a cheap stock, and let's say the 90% failure happens, like, should you get pissed off that that you don't get a 50 bagger or 50 bagger every time you put a high risk, high reward bet in? No, you shouldn't. And it's like, just this about elephant hunting. I think that's just from a long-term hodl perspective. In my book, you want to aim big, miss big, and could still win. Because take Snowline for example, maybe blue sky for Valley was like 50 million ounces. Who knows? I mean, if the entire intrusion was as mineralized as the first, or as the good parts of it, I mean, it would be absolutely enormous, maybe 50 million ounces. Snowland is still one of the best successes in the last decade or something in the gold space, without hitting theoretical blue sky. That's one where it's like, and I mean, compare that to a junior where it's like, it's a remote location. It's like you need 3 million ounces or this is a no-go. And the blue, and based on what you're seeing, it's like, and based on how those maybe systems tend to work, it's like, yeah, there are very, very low chance of reaching blue sky. It might be a decent version of that kind of system. Maybe it's like you would be happy in other, in a typical scenario, you would be happy if these systems delivered 1.5. So you would need, let's say, the miracle blue sky materialize. Otherwise, the project is dead to begin with. Is that good risk reward? You need blue sky, or there's no value at all, really. That's not the best kind of. You want low thresholds for success. I mean, if blue sky is up here, you pay this price. You have, it's a, let's say, good jurisdiction, good infrastructure, whatever. It's like threshold for success is here, whatever. If that ends up being anywhere from here to here, let's say 40 to 100% of blue sky, you'll win. But if it's very remote, you need almost to hit blue sky, then it's like, this is your long-term win condition, that it actually, gets to 10% from blue sky, whatever. Or if it's, I don't know, really close to, an operating mine that's hungry for feed or whatever, maybe the threshold for success is like super low, like 500,000 ounces in Nevada, that's going to be good. And you start off with, I don't know, 300,000 ounces or whatever. I mean, that's a very low threshold. I would prefer to have high blue sky as well, but everything, blue sky, critical threshold for success, the price we're paying, I mean, everything goes into the risk reward. Because let's say there is a very low threshold, but price is up here. I mean, then all of a sudden there, risk to the downside, even with I mean, if 500,000 ounces works, but it's trading at 200 million, and the blue sky is like, I don't know, 1 million ounces, for example. I mean, the risk reward isn't really that great. And the only thing we know at all times is the price. That's the only thing we can control, what price we paid for every eventuality in the future, let's say. And confirmation bias. I mean, everybody says confirmation bias is so bad, etc. But in my book, it's like, I think now is a good time to use confirmation bias. I mean, I can feel it myself. It's like, let's say you have a shitty day in the market, the market is sour, everybody's sour on Twitter. It feels like, again, it's like, let's say a false start. Well, we were at all-time highs recently and now go down again. It's like you feel like, this is never gonna end, which is, I mean, it's a false statement, but that's how it feels. But when you see someone post, maybe it's a perma-bull in the gold space, I don't care, but it's like you see someone who's like, this is a bear trap, gold is gonna go to $5,000 within 3 years or something. Then your spirit gets lifted. Because then you're thinking about how much you could win again, not how much you, let's say, have lost or might continue to lose next week or something. Because this is totally irrelevant in the long term that it's down $20 today, but it affects people, and that might get some people to sell out. It's like, I can't do this anymore. That's what typically happens. That's why the prices, the worst bear markets, I mean, they get the most irrational, because the longer the trend is, people just sell for. The reason they sell it has less and less and less to do with the valuation. They're not selling because they thought they hold something that's overvalued. They sell just because they don't see any hope left. They don't see that it's ever going to turn around. So nothing to do with value investing principles. They sell because so many people have sold before them. So it's a self-fulfilling prophecy, I was gonna say. So it's like it's like worse and worse the cheaper you sell, obviously, but more people throw in the towel the longer the trend persists. So it just gets more and more irrational, the reasons for selling, and that's why prices undershoot and overshoot. So it makes total sense from a psychological perspective, really. So in that case, like, is confirmation bias bad? I mean, should you be listening to gold bears right now if you're invested in gold units? I don't think so. I don't give a shit if someone predicts gold is gonna go to $1,000 or whatever. Like, the gold units are pricing in a shitty sector from a value perspective for a long time forward. So even if gold goes down, I didn't even overpay. I mean, yeah, I mean, if it goes down to like $1,000 or something, maybe overpaid in some, but it's like, at the same time, you know it's going to turn around as well. So it's like, if you're buying cheap, I mean, the work is kind of over. It's like, the risks are to the upside by default. And what if gold turns around within the next 3 months and heads to 2,200, and all of a sudden everything is kickstarted in terms of sentiments. Like, this time people are, for the first time it's like, oh, we're actually through 2,000 for real, or 2,100 or whatever. Imagine what's going to happen with some of these gold juniors if that's the start of the next sentiment swing. Versus the risk I'm taking by buying something that's priced as dog shit, and the sentiment stays dog shit a bit, and gold maybe goes down here. It's like, I mean, they shouldn't even go down. That's how cheap they are. So from a price to value perspective, I don't think there is any risk to the downside long term. I mean, from obviously all else equal. There's always like, yeah, something could happen with projects and dilution, whatever, but just at face value, there's no valuation risk to the downside in many of these high quality juniors. They should already be maybe hundreds of percent higher, and I have little doubt that some of them will one day. So I guess my point with confirmation bias is that I think it's also one of those things that, again, it's like a tool. People say, confirmation bias is bad, but if you know what's right to do, meaning it's like, it's cheap, this is like a buy and hold environment extraordinaire, let's say, and you think the biggest risk is to lose faith or whatever, then, I mean, confirmation bias makes kind of sense as a remedy to that. If that's what keeps you in the game, whatever. I mean, I don't see that as a bad thing, even though it's like many of these rules that, you should never have confirmation bias. But it's like, if that's your weakness, that you get negative when everyone else is negative, to keep yourself positive, I mean, that's just a good thing, I would say. Obviously, in reality, the ideal situation is that you shouldn't need that. But it's like, I find myself get affected. You see someone who's like, random user on Twitter is like, in Q3 of 2024, miners are gonna rip the face. That makes me feel good. So even though I'm a value investor, I like to buy cheap. I mean, at the end of the day, yes, it's tied to the idea of big paper profits in the future. That's the case, and it does feel it a bit better to be holding out. If you just some random guy says his belief is that gold units will go up a lot by Q3 this year. All of a sudden you're starting to look forward to something, which we should be looking forward to, the next inevitable bull, which we can't see, we can't feel it right now, but we should have the mindset that there's 100% guarantee that's going to happen. And on that point, it's like, I think it's good just to, again, keep your, I was going to say, conviction. It's like, you should write down, because I actually, it's funny, it's like, when I write an article about a company or whatever, I typically get more bullish about it, because I think I have a pretty good sense of like, if something is cheap, worthy enough, let's say, to have on as a sponsor. And when I really dig into it, it's like, typically, that might be, I mean, it's gonna obviously sound like, bias because they're sponsors, but typically everything is cheaper out there right now than one realizes at face value. And when you really dig into some of the fundamentals of these juniors, and that's not just from companies I own or anything like that, I think there's a lot of cheap companies I don't own, but I do think one starts to really appreciate how batshit crazy this sector is right now. And to have the conviction to stick it out, etc. We should it's like, why are we in here? Why do we buy low? For future outsized returns, of course. So I think it is a good idea to remind yourself, if you need to, why you hold, well, first of all, gold juniors in general, or any junior, nickel, copper, whatever, but also company specific. Because let's say you did your due diligence on some company, and you're like, whoa, this is really cheap. You bought it. Let's say there's no real news out from the company. Let's say there's no hype around the company. Maybe share price hasn't gone anywhere. And it's like, you're feeling like, you start to forget why you bought it in the first place. And there's not few times that I have, given up, let's say, on a company, which I started out buying because I thought it was cheap. Maybe it's down 30%, whatever. And I kind of forget why I thought it was cheap, because there hasn't been any news. And then you try to, you do the things like, oh, nothing is going to happen with this company because there hasn't been any news in 2 months or whatever. And that goes, same rationale behind the bear market. It's like, why you sell at lows, because, well, nothing has happened yet, and you start to forget that, they could happen. Or 2 months more of a bear market is 2 months closer to something happening on the positive side by definition, because every bear market ends. But you kind of keep forgetting that. So, I mean, on quite a few occasions, I end up throwing in the towel in some junior, where nothing is really changed, and we get closer and closer to some kind of news, and I end up throwing the towel because I haven't seen any news, and I forgot about, my conviction got lost. I haven't, went back and dug into the company, and the next day they put out a news release or something, or the stock just pops 20%, and that was the bottom. It's like, I mean, it has happened, and I've literally sold like the day before a bottom. So I was the last dumb one, the last weak hand to sell, which is the dumbest thing to do. It's the most costliest thing to do, to be the last one to sell. So I think it's a good idea that for your entire portfolio, every holding you have, you should again be able to come up with a simple case that you can remind yourself of. Could be, simple stuff like, they have this amount of resources. It's trading for this, obviously cheap, maybe good management, maybe good jurisdiction, maybe third-party validation, whatever. It's like, so you can just go back and like, all right, this is why it's cheap, this is why I got interested. Because otherwise, I mean, you start to forget, the more time goes, you start to forget the fundamentals of companies if you don't go back and look at them all the time. And it's like, I also think what I really like to do is like spreadsheets. I did a lot of spreadsheets in the 2015-16 bear. Valuation spreadsheets, and it's like, how much is the stock down from the 2-year high or something. I mean, I remember buying like Endeavor Silver or something. I think it was down 97% from the 2011 top. Some companies I just bought because they were down the most and stuff like that. But I had valuations as well. But like, just to make, simple spreadsheet. I mean, these columns or this columns here, this column here or this column here. I mean, that kind of gets you excited because these numbers go up the lower the market caps go, which is how it's supposed to be. The cheaper something becomes, the more upside potential there is, all else equal, unless something changes that makes you, I mean, fundamentally, that makes you change the whatever probability or how many ounces they might have, or the jurisdiction premium or jurisdiction discount, whatever. It's like these are just a few companies that I start doing because I like to do this stuff, and it's like if you're buying, well, I was gonna say it's hard to buy something in a downtrend if you think about if you're buying for the next week or something, because you will always guess that the weather tomorrow is gonna be the same as it is today. But if you think about like, okay, from where we are, sometime in the future, when the sector sentiment is better and the inevitable 100% guarantee bull has come, how much will some of these stocks, or how much might they sell for, and how much might they have in terms of resources at that point in time? Then it comes back to the long-term value investor. What price am I paying today, and what value will there be in the future? That's all the opportunity there is, because everyone else is trying to guess where the stock is going to go tomorrow. That's extremely hard to do, and there's no, in my opinion, big money in that. Then you start with like, oh, I mean, hey, I wouldn't say no to, possibility of 468% on the money I put into a stock, or 300%, or 400%, or 445%, or 500%, or 383%. I mean, that's my point is like every single junior holding you should have, it should be a screaming buy, basically. And a screaming buy, when people ask me what's a no-brainer, how do you know which are going to go up? I have no idea. A no-brainer to me is not something I know I'm going to make money on, because I have no idea. I've lost money on things I was sure I was going to make money on. I've made money on stuff that I had no idea I was going to make money on. Just look at Hercules Silver. Had no idea we're going to make a copper discovery. Just look at Novo Resources, super bullish on that one. And yes, it's like, and I, as I've said before, I still don't regret my investment in Novo. I understood the bet. So a high risk, high reward bet. If they do end up proving up, a new paleoplacer gold district, like, given how extremely large it is, even $1 billion would look cheap. So it was a high risk, high reward bet with a high valuation store, unconventionally large valuation, because the price, theoretical price was unconventionally large. But there are also stocks that are like more sure I think I would make money on, but didn't end up doing well. Let's say there's a nice oil anomaly. It's like there must be something there, but there wasn't. For some reason, Mother Nature didn't put any metal endowment under that soil anomaly. So stuff happens. No brainers, just a risk-adjusted, risk reward basically. I think there are no brainers out there where it's like maybe the chance of success is just 15%. 85% chance of failure. So out of 100 similar plays, only 15 will succeed, but I think it can still be a no-brainer because it's so cheap. It's, again, if that 15% chance happens, you're going to make so much money that you don't need to be right very often. That's a no-brainer, even though it's a low chance of success. And some are obviously more risky than others. Some are cheaper than others, but like if and these are just, I don't know if share structure is updated. I did this I think a few weeks ago, and it was just to have something to do, but it kind of, again, I was gonna say makes sense. It's like Goliath, which I haven't covered in the news yet, but they put out news today. take Goliath. I mean, I just used the previous news release, their model numbers there for the Shorebet Zone, Bonanza, Shear, and Golden Gate. You know, they have a model, like the potential is these many million cubic meters of mineralization, average grade so far seen, yada yada yada. Then you come up with a like blue sky number, which is, let's see what. Oh, 17.5 million if my calculations are correct. Total blue sky potential across these. And there's no way you're gonna mine that 100%, even if it was in fact exactly this grade, that many cubic meters, this amount of tons, etc. Because you can't. I mean, the mountain would collapse if you know what I mean. You have to have some pillars and stuff, and it's not gonna be homogeneously mineralized. But in this case, I just added like, okay, maybe Shorebet Zone, maybe theoretically $150 per ounce in the future for every ounce there, because it's higher margin, higher grade. Maybe 100 here, 50 for Golden Gate. I mean, that could be. Nobody knows what the true value will be. It's like in a buyout scenario. I mean, the better the project gets, the higher the premium and all of that. So there's a lot of like unknowns, but these are just some guesstimates. It's like, I mean, it's who knows. I mean, if the gold price is $3,000 in 2 years, you're not going to see high quality projects being sold for $150 per ounce, maybe $400, $500 per ounce. So I mean, there's an extreme amount of unknowns, but I'm trying not to be overly preposterous, let's say. I mean, in Canada, I don't think $150 per ounce is outrageous at all. And then you come up with a like, okay, blue sky valuation, if there would be this amount, but let's discount that by 50%. There's like half of this could get mined, or they will find and 50% of it could be mined, or let's be even more conservative, so like 70%. So 30% of all of this materializes and could be mined, whatever. It's like that's still $606 million in that case. And here I actually used 5.3 million ounces. Again, not 17.5, but like 5.3 million ounces, $150 per ounce. That's like 788, and I think that's cheap. And in that case, it would be a 912% upside from the current market cap. If this market cap is correct, maybe they have a few more shares. But that's solid upside without hitting absolute blue sky, because I think it looks increasingly likely that they could reach 5 million plus. I mean, especially the news release out today, for example, they talk about a new vein set, a jackpot, where they hit up to 663 grams per ton AU. Well, what was the AU equivalent? Maybe they don't have that, but I mean a lot. And you see it's like 1344, 1.6 kilograms silver, 8.4 is almost 700 grams per ton AG, 6.9 grams per ton AG, 303 like 10 ounces of silver, etc., etc. And here you have the total bonanza thing. Is there potential here? I mean, they traced this for 500 meters. Yeah, I mean, obviously there's potential here. You don't see these kind of grades every day, and that's obviously on top of Shorebet Zone, Bonanza, Shear, Golden Gate. And here you have the blue sky models. So I mean, I think in case of Goliath, I think the market is absolutely batshit crazy, but at the same time it kind of makes sense. I mean, I think value has gone like this or something, and I mean, over this period here, for even farther out, I mean, the bear is 3 year long or something, but it obviously is worse the lower it goes. So I mean, does this short make any sense from like a valuation perspective? No, absolutely not. It's at the same price as it was here. Does that make any sense from like, yeah, it's exactly, looks exactly as good? No, I don't think so. I think gold is higher as well. No, it doesn't make any sense, but that's the thing with the market. Most of the time it doesn't make sense and everything is kind of relative. For some reason, I mean, this is just obviously some kind of trading resistance. There's nothing magical about 90 cents or 93 cents or whatever. But in this low liquidity environment, uh, traders typically influence a lot of things. And that's the thing. One could complain about it. That's like, got them traders, they're not allowing Goliath to go through this resistance zone, for example. But at the same time, I mean, let's say this was the price to value gap back here, and now it's up here. Obviously, that I mean, there's a bigger price to value opportunity here than here. So again, it's like, should one be complaining too much about the market? Maybe this is twice as good of a buy as it was here. Maybe this was a good buy, now it's, a great buy. Should you be complaining about that? I wouldn't say so by definition. If I was broke right now, that would suck. Because I can't do anything with the increased opportunity in that case. But okay, what do we have? I mean, what's the market thinking? Obviously, this is well. I think we got a few things going on here. We have, well, there's some more results coming. We got more results today, but I think there's even more results coming or might be coming. But then we're going to the, winter hiatus. Okay. So there's no get rich tomorrow, unless they would get bought out, I guess. But it's like there's no real, after that there's not going to be any assay results, so you can't shock the market from assay results. Most people buy stocks they think will go up in the short term, or has a chance of going up in the short term. So I would say the market is already front running that. That there's soon going to be a assay result pause, if there isn't already. And then they might need to raise money for the next drill season. And obviously, if you really like this project, which I really do, if you have big money, let's say you can't really buy in the open market, well, I love the project, they will need more money to show how big it is, I want to get in bulk. Would you rather let the price go past here and trade closer to an ever increasing, price to value gap, closer to fair value, let's say? Or would you rather have the price stay down so you can get in with a big position at 80, 90 million Canadian instead of 150 or 200 million Canadian, if you think this is going to go to a billion? Obviously, you would want to pay as low as physically possible. So I think you got some of that stuff going on, and that's not just for Goliath alone. There's no shortage of juniors like that, and it makes perfect sense. If I want to put in a few $1,000,000, and I think, well, hey, I think this is going to be a top tier mine one day, let's say. I think this has the potential to be 5, 10, 15 million ounces. Either from what you see here or the district itself, and I can buy that for 80, 90 million. If I can get in with bulk, that would be lovely. I would rather pay that than 200 million because there's less upside in that case. Obviously, I wouldn't mind seeing the price down here or be kept down here. You see that stuff all the time. It's like, I don't particularly like it. It's frustrating and all of that, but it's like sooner or later, let's say this, in my opinion, apparent price to value gap is unsustainable, because they have good hit rate as well. So there's nothing to suggest that SureBet and the other zones are not gonna get bigger and bigger with each passing year. That the value trend is indeed up, and probably is gonna be up for a few seasons yet. So, and I think they have released a lot of good news, which has increased value, but the price has been stuck. So again, I think this is a increasing price to value gap. And that's the thing with being a value investor. You have to be really patient. Lord knows you have to be really patient. Because if you thought it was an opportunity here, and let's say you bought here after a dip, and you watch like, hey, they're delivering. It's like it's getting bigger and bigger and bigger, and you see price go like this. What typically happens is that you end up throwing in the towel, because you start to expect, well, this is never gonna go anywhere, because it hasn't gone anywhere for like a year. But if you were like, no, I'm sticking to my guns, I think, yeah, price has gone up. It's like this column here is like the upside. That's just gone up because value has gone up. Now I think they have 5.3 million. Back here, maybe you thought they had probably 3 to 3.5 million, whatever. Maybe there's like 150% risk-adjusted value add, more than the current market cap. Then you would obviously get even more bullish and think this is even more unsustainable, that it shouldn't be here and not even here anymore. It should be up here, at least, let's say. So you're gonna hold on, and if you're kind of right, you're gonna make a lot of money. And every success story has these dips. And again, you can kind of understand why is it kind of subdued. Well, you have a resistance, so nothing to do with value. You have the fact that the company will probably raise money for the next season. Then you have a lot of people who like the project, who would actually like to see it not trade higher, so maybe they get a warrant and all of that, because they think it should be up here, and they want to keep it as far away from this price as possible until they can take a bigger stake or a big position or whatever. And then you have people that are like, okay, this is going to be boring because there's a winter hiatus. Because again, almost everyone is short-term focused. But if we're long-term focused and we're thinking, how is Goliath going to look in 2000, who knows, 25, 26, at the current growth pace? Well, you might be thinking, I think they're going to have pretty obvious they're gonna have maybe 6 to 10 million ounces in 2 drill seasons. I'm just making up numbers here. In that case, like 6 to 10 million ounces in, let's say, 2 years. What's that gonna be worth? Let's say 1.5 billion. All of a sudden, today's price is starting to get really cheap, and even if you diluted that by 50%, that would be really cheap as well, etc., etc. Then it's starting to again extrapolate. Then it's starting to feel like a no-brainer hodl case, because the current trend has been growth. The foreseeable trend looks to be growth as well, and now with even more growth potential. And they're going to be testing this as well, and they have more targets than this. All of a sudden I start to think it looks, where is it? Here. I hope you get my points. Like, ask me, where's Goliath gonna trade next week? If someone's like, what's the case for Goliath over the next week? I have absolutely no idea. 1 month, absolutely no idea. 6 months, I think it's higher. A year or two, I think it's definitely that the risks are very much to the upside. So that's obviously what my bull case would be in that, that this price relative to 1 or 2 additional drill season. In that case, yes, it looks like a no-brainer. But if I do it shorter than that, all of a sudden it's not a no-brainer, because even though this might be very cheap relative to the value it's going to be in 1-2 years, I have no idea how the market is gonna, what the emotions of the market is going to be next week or next month, because it's not driven. It's like Warren Buffett says, in the short term it's a voting machine, in the long term it's a weighing machine. This is the weight of Goliath, in my opinion, increasing in substance. In the meantime, you have a lot of voting going on, and then again you have stuff like I just said, that you have the winter hiatus, you have the possibility of a private placement. I mean, in my opinion, I mean, one thing on that note is like, who knows, maybe they announce a private placement, but it's not with brokers or whatever, it's with I don't know, Agnico Eagle or something. So it's like, yeah, Agnico Eagle comes in at a 20% premium, and all of a sudden, shit's gonna, catch on fire. I mean, that's also a possibility. But the main thing that those are some we don't know, and we don't know if it's gonna, how it's gonna play out in that respect. But if we just look at the fundamental trend, I'm pretty sure Goliath is gonna have the risk more and looks to be more valuable in 1-2 seasons from now. And if I have a ballpark figure of what I think it's going to weigh in 1 or 2 years, let's say 5-6 million ounces, I think this is going to look incredibly cheap. But I can't make a no-brainer case on a shorter time frame than that, if you know what I mean. So that's where the opportunity is in my book. It's not where it's going to move next week, next month, or anything like that. It's just that, again, fire and forget idea. The low maintenance hodl case is like, if I come back in 2 years, I think I'm going to be up. That's it. If I come back in a week, I have no idea if I'm going to be up or down. And if you're kind of right and the base case kind of plays out, in 2 years it's not going to be, it's not probably going to be that, okay, if I'm up I make 50%, if I'm wrong I'm down 50%. No. If I'm right, you might make 500%. If you're wrong, you might lose 50%. Who knows? But it's going to be hard to undrill what they have drilled, at least. And it looks increasingly likely that the more news they put out, it looks increasingly likely that they're closing in on a critical threshold for success. I mean, they don't have a resource yet, but it's like, I think there's higher and higher likelihood with every passing news release that they will have something one day on paper that is mining worthy. So that's as simple. Okay, so how do you make a case, let's say, for Goliath? It's like, what's the elevator pitch? Well, they might have anywhere from, who knows, but it's like anywhere from, and nobody knows this for sure, anywhere from 3 to 15 million ounces, and it's trading for 90 million CAD. So the question is, how right do you need to be? Well, that is worth, for example, or it's going to be worth 788% one day. It's around 10% chance of that happening. That's priced in. So I would need to be right on that 1 in 10. If I had 10 Goliaths, I need to be right once that it's actually worth 788 in the future, not 77. And I'll get my money back. And that's assuming the other 9 go down 100%, which is unlikely. What they found up until now is like, is that typically gonna be worthless? If the company would go bankrupt or whatever, but it's like, I don't see Goliath going bankrupt 9 out of 10 times. So it's actually even better risk reward than that, on a long-term perspective. And obviously the thing is that the upside might be much more than 788 million. What if they have like 5 to 10 million ounces and we go in a hot market environment? From this market cap, there's a lot of room to the upside. What if they find 10 million ounces and it sells for $200 per ounce? That's 2 billion. It's more than double this, and I need to be right one in whatever. 1 in 25 or something like that, and that's assuming the no, not 1 in 25 perhaps, but yeah, well, somewhere along those lines. But you get my point. I mean, there's and it's not just Goliath. I mean, there's so many no-brainers. Like the odds of all of them going wrong, and if they go right, they don't go up 100%. And if some of these go bad, they're probably not going to go down 100% either. So it's just, again, it's like I love this sector because it's so it has no self-awareness. I was going to say it has no idea about risk reward. That's why it's, I mean, the crazier it is, the more volatile it is. And this is a sector people say, oh, I look at Mr. Market, what the Mr. Market is doing. Just look at Bear Creek Mining. That stock goes down 90% and up 500, 2,000%. I mean, imagine how wrong the market is, chronically wrong about that stock. It's like there's a black swan every 2 to 8 years or whatever. There's no way, I mean, it's not a black swan anymore in that case. That's a pattern. So, yeah, I simply think... yeah, I mean, I think this is one of, in my book, this is a no-brainer. I don't think I need, I think this is the current price is way underestimating the fundamentals, what we know about this project. And that's obviously the opportunity. We can cry about the stock being down from all-time highs, but it's like it's probably much better bet here than here. So let's say you had 1% here, so maybe you should have 5% here. And thanks to this move here, and you realizing that it might be a better opportunity, all of a sudden, I mean, if you had 1%, let's say, and it went like that, okay, you have 1% that goes up, I don't know, 40%. Instead down here, so you earn 0.4% to your portfolio. And let's say here you have like 189% on 5%. I mean, that's almost 200%. So that's almost, that's almost 10% to your overall portfolio from a 5% holding. So almost 10% versus 0.4%. This is going to feel much better, but you actually end up going to make, or if you did that and that happened, you would end up making 20 times the amount of money on Goliath than if we didn't have this correction. So again, the question we need to ask ourselves, and it's like the idea with volatility is we want to take advantage of it, and by default then, or I should say volatility is never bad by definition, even though 95% of people think that. It's, as soon as a stock you like goes down, it's a curse. Which is bullshit. I mean, just think about it. I mean, obviously, in this stock, for example, you could make a lot more on Goliath that instead of going like that, straight line, let's say efficient market wins, it just goes up like that and you earn whatever, let's say 40% something, instead of going like this to the same end destination. Obviously, you could make a lot more because every single buy in if it went this way and had the same destination would have a higher future return than this line here. Why? Because if the end is the same and this price is lower all the way from here to here, that means you would make higher returns with every buy in the scenario where the stock went like this instead. Which is again the very same scenario that everybody would bitch and moan about and why this sector sucks. Even though that's literally, in this case, a huge gift. So think about that. That's why I keep saying, it's like, if you hate corrections, if you hate bear markets, you just hate making money. That's how it is. I mean, obviously most people don't see it that way, because everybody, if they made money in the short term, then I made money in the short term. So everybody think they're at face value. Yes, you're kind of printing money in this way here, but unless you're supposed to retire or you sell everything here, well, from here it's pretty depressing. So yeah, that's why I say it's like you shouldn't cheer too much about paper profits or paper losses. It's a long-term game that all that matters anyway. Yeah, this video has gone on long enough, but again, I hope you get my point, and that's why what I want you to leave you especially with, and if you master this, you're gonna be an absolute killer, and I don't see how you ever not beat any sector over the long term. Again, just remember that every time you see volatility, ask yourself, you see what the market did. Again, we're not trying to predict every single volatile move. You're not, in my, well, that's not what I'm doing at least. Predicting every swing is like be exactly positioned for every swing, whatever. It's like, how did the risk reward change? We saw that in Hercules. It went down 48%. Okay, so we slap on a 48% paper loss from the previous day. But what now? Is it a sell? Is it a better buy? Is it I mean, we shouldn't really have holes, honestly. So that's it. Like, either it went down 48% and it should go down even more, and it's overvalued, and it's a sell, and you cement that 48% loss, because that makes total sense. If it went down 48% in price and is still overvalued, that's a sell. And you can't go back in time, and there's no point. It's like I see some people that they refuse to sell a stock at a loss because they don't want to sell at a loss. How much sense does that make? Let's say a stock goes down 48% on really, really bad news. Stock should really be down here, so it's still overvalued. But you found, or you have another stock in your a stock with an intact case, where you think the value is up here and it's selling for down here. So this should go down more and stay down, because this is here's value, here's price. In the other stock about, here's price, here's value. So here you might have an expected return of, I mean, this is probably a bad example because, I mean, junior sector can swing this much in a given day, but let's pretend this is 120%. That's what you can see in the price to value gap, or price to future value gap. If it's a growth story, for example, your base case, risk adjusted, 120%. So you think, all else equal, risk adjusted, you get 120%. If you could play this case an infinite amount of time, you think you're gonna have 120% returns. Why on earth would you not sell this that is down? We pretend this is like 50%. Oh, well, it went down 50%, and let's say there's 7% more downside left, and that would make sense. Why be in a stock just because it's down and wait for it to go up if it shouldn't even go up in the first place? Maybe the case went to shit, maybe the story's over. You just have to suck that up, take that loss, because for all you know, you could make, let's say, back this loss here in this stock at least. And then you have a shot at another, you find another, let's say this revalues, you get 120%, so you make that all back. And then in the next time, in the next run, or when this has played out, you find a stock with 120% upside. Yes, your portfolio might go like this, so it takes some time to. You lose money in one case, get it back in another, and then you find a third that also works out. Still, if this is like, I don't know, 3-year period, maybe you're up 100% over 3 years. That's great. Much better at least to like not sell this and jump on this one, because you don't want to sell at a loss. So instead you wait until it actually goes to fair value, which is even lower, because the news was that bad that even a 50% haircut wasn't enough. And if you stay in this stock, it shouldn't really go anywhere. So let's say you just sit and wait for to come back here, which it never does really. So in this case, over 3-year period, or I should say in the other case where you actually sold out, got it back, and then made some, let's say you would be up 100% here from 3 cases over 3 years. That's great. Instead, you were stubborn because you wanted to make the money back the same way you lost it, even though you shouldn't, because the price to value gap isn't there and it's not positive. So you lost, let's say you lost minus 50% here, and then it goes down to fair value and stays there. Let's say you're down 70%. So in 3 years you're still going to be minus 70% because you refused to put the money at work at a better place. Whereas like you could immediately have sold the 50%, taken that bitter medicine, but it makes perfect sense, because why be in a stock with expecting negative returns when you have one that you expect to have 120% positive return, and then you find another one with 100% or whatever. Again, does it make sense? That's all I'm asking. No, it doesn't make sense. And then of course you have cases where it's like price went down 50%, value didn't go down 50%. So in this case, here we assumed value went down here. Maybe a stock goes down 50%, but value has kept on increasing. Why not buy a stock like that instead? Imagine the difference between, let's say you bought a stock here, it goes down, let's say 50%, it should go down 50% or 60%. There's no positive expected returns in that stock. But then you have, let's say Goliath went down 50% and value has gone up. So the expected value has actually gone, let's say it was actually negative here or whatever. But now on a forward basis, it's plus 174%. So again, same correction. One that should go down and stay down. One that went down shouldn't have gone down and it's not going to stay down or should not stay down. Completely same price development in the first place, completely different outcomes. I think that rules or psychological crutches like selling half at a double, wanting to make it back in the same stock, none of that makes sense. The more strict rules, irrational rules you slap onto yourself, you can just imagine how that's gonna go. Imagine you did this mistake every time you were at a loss. You refuse to sell a stock that's gone down because you're down. Okay, maybe a lot of the time you're gonna see it minus 70% in 3 years. Okay, then you have the ones where you sell on a double, where you maybe should have doubled on a double. That's gonna lose you money over the long term. Well, it's not maybe gonna lose you money in a case by case example, but you're gonna lose out on profits. Then we have the not chase a stock. Maybe a news release comes out. There's it should go up 200%. It goes up 50%. But your rule is that I'm not chasing stocks even if the news is worth 200% of the current, or it should be 200% higher, but you don't chase a stock, so you never get into it, you miss the whole ride, because obviously if you don't buy it after it's gone up 50%, it's going to be feel even worse to chase it, quote chase it. If it's up 100% or 200%, you're going to be one of those people that say, congrats to all, I missed the boat. Where in reality you might not have missed anything at all, but you decided that the boat was missed, even though the boat was still at the pier. So add up all those scenarios where you do those things based on some rule or psychological crutch, and you can see how detrimental that's going to be to your long-term portfolio returns. Every single time you're going to do those mistakes when they come up. You're never going to buy a Discovery if it's up 50%, even though it should, let's say. You always take half off the table after a double, even though the case might be more than 100% better. And you stick it out in failed stories, let's say. When you, again, the opportunity cost, if you know you have a place where you think the money is actually going to be working in your favor, where you think the price is lower than the value, that's opportunity cost. And if you don't jump on them and you rather just, stay and just hope for to make it back in the same company, by definition, none of that makes sense. Anyway, thanks for listening. Again, I hope this makes sense. Don't see this as investing advice. Assume I am biased. I own shares of a lot of companies I mentioned, and assume some might be sponsors as well, so consider me twice biased. And hit the like button and subscribe or whatever, or leave a comment if there's some questions. Thanks for listening. Bye.